Welcome back to The Mind of Money. We are at session 3 with economist and investment advisor Benjamin Lodmell. Welcome back, Benjamin.
Thank you.
So again, we left off last time and we talked about the dips and the highs, and traditional investing, the way that most Americans think about it, is you buy low and you sell high. So you want to get in at a low price, you're kind of waiting for it to go up, and then you have a profit-taking concept, which feels a lot like a roller coaster. It's why people jump out of buildings when it goes down, because their portfolio just tanked, etc. In the last session, you talked about a completely different philosophy, where the goal is not to look at the price at all. The goal is to accumulate wealth in the term of shares of companies that are truly companies that you believe in. And when you have that goal and that mentality, when the price goes down, it's actually an opportunity for you to get more shares at a lower price.
Right. You see, you change your vision from wealth as market value to positions of shares.
Right.
And
so I know a lot of statements literally have on the left side of the page a position, X thousands of shares.
4,000 shares.
4,000 shares of X company. And on the right side, it'll tell you your market value. I know that one exercise is to simply cut the right side of the page off. Don't look at it. Just look at your position.
Look at your position and
your
look at the price.
Average price.
Yeah, the price is nothing other than a signal to determine when you buy.
Right.
That's the best way to understand prices. Because most of the time, when you've done the proper analysis on the financials of the institution, you understand that its price can be affected by the storm of financial markets.
Sure.
Of course, the crisis that just occurred is the ultimate example of that, in the sense that forces that had nothing to do with the balance sheet of the company or its sector or the corporate governance. Those are the things that would really change your assessment of whether this is a good investment or not.
But the price is going up for macroeconomic reasons, for completely unrelated reasons.
Liquidity issues, for financial. Think of financial markets as being affected by very strong winds.
The butterfly effect. A butterfly flaps its wings in India, and the financial markets here.
There you go. So think of when you really have done the homework to make sure that the financials, that the role that institution plays in its sector, in its marketplace, that it's in a growth market, then you're really not concerned about the market price, because you realize that's something that's affected by winds that have nothing to do with the financial statements of the company. So,
so let's talk about some specific stocks.
Okay.
Give me an example of just maybe 2 or 3 stocks where you would believe in the stock, and how you would go about getting into those stocks, and why.
Okay.
Yeah.
Well, we talked about 3 major changes in an investor's mentality. One is understanding that you slowly diversify out of U.S. dollar and into other hard currencies.
As a measure of storing value.
As a measure of storing value.
Okay.
That you are also aware that growth in the world is no longer in the United States or in developed economies in Western Europe.
Right.
Growth is in the big emerging economies.
Right, and those would be, in your book, the big ones are? Of
course, Brazil and China are the leaders.
Top 2.
India and Russia to a lesser degree. And then there's a whole coterie of what they call frontier markets. There's a lot of excitement around markets like Indonesia that are growing. And that's a big shift in the mentality of your average retail investor in the United States to think, wow, I need to hold my wealth that is waiting to be invested in equity, in non-US dollar currencies, and that I am going to be buying into individual shares and not worrying about the market price, because other than it's a signal to buy. And that I am no longer seeing the United States or Western Europe, for that matter, as the marketplace where I search for growth.
Right.
This is a radical shift for most investors, but it's one that they need to make, and make now, because every day is passing. And I think there's a few markets that are particularly good places to begin. I would say the number one is Brazil.
Brazil.
And the reason is think of Brazil as the United States in 1982.
Right.
It's a $2 trillion economy that's poised to become a $10 trillion economy.
Right.
It's a big homogenous nation. There's more than 200 million people there. It's a very stable market. And they've also adopted a very American style, United States style.
Consumerism.
Of growth.
Yeah.
And even the way their cities and their marketplaces are evolving is very, very much like the United States. So
they're debt free. They're energy independent. They have a huge amount of their own natural resources. They've actually had very good policy over the past 10 years.
They have an incredible commodity story, and raw materials or commodities were things that poor countries used to export to rich countries in order for them to turn them into something valuable. Now